Welcome to P2 Corporate Reporting. In this section, we are going to look at reporting income taxes in the financial statements. Now, if you are working currently or have worked in the past, you have probably paid income tax. Like it or hate it, you have to pay it. The standard that guides us in recording income tax and deferred tax assets and liabilities is IAS 12, which you've already met in F7. The F7 section has a number of videos that clearly explain this standard. Please watch these before continuing with this video, where I am going to do an example. Wowza Incorporated is an IT company. Since its creation 5 years ago, it has been developing an app which they plan to launch in 2 years' time. The company has gained losses of $1 million over the past 5 years, and in the current year 20x7 it has made a further loss of $200,000. The current corporation tax rate is 20%. How should this be recorded in the financial statements? Okay, so pause the video and attempt the question. So what have we got here? We have losses up to 20x7 of $1 million and then a further loss of $200,000. These losses can be carried forward and put against the company's future profits, reducing the future tax bill. So in this situation, by the end of 20x7, Wowza Incorporated can generate $1.2 million in future years' profits before the losses are all used and the company will have to pay tax. So these losses are valuable, aren't they? In money terms, they are worth $1.2 million at 30%, $360,000. Because without these losses carried forward, the company will be liable for this amount. Under IAS 12, a deferred tax asset is recognised for an unused tax loss carried forward or unused tax credit if, and only if, it is considered probable that there will be sufficient future taxable profit against which the loss or credit carried forward can be utilised. So it must be considered probable that the company will be profitable to use these losses. And based on what we know so far, it doesn't look probable. There is no sales contract which demonstrates that the company will make a profit. And the company has been consistently making a loss in recent years, which, according to the standard, indicates that it is not probable that the company will make a profit in the future. Therefore, no deferred tax asset should be recognised. Now, what if the company is likely to be profitable and had only made a loss in 20x7, but would return to profitability in 20x8? You would need to be very certain of this. In the exam, look for concrete reasons or evidence why the asset should be recognised. So, for example, an agreement to enter into a contract of sale in 20x8. Obviously, this contract would need to be profitable. However, if profitability was likely, then a tax asset could be recognised. It would be recognised as follows. Tax losses brought forward $1.2 million. It is important to note that tax losses may differ from accounting losses, as certain expenses may not be tax deductible in certain jurisdictions and will have to be added back to the profits or losses to get the taxable profit or loss figure. So the taxable losses brought forward are $1.2 million and the current tax rate is 30%. As you saw earlier, this is a tax asset of $360,000. The double entry is debit deferred tax asset $360,000. This is recorded in the statement of financial position. Credit tax in the income statement $360,000. And as with any standard, you will need to apply the disclosures. If no asset or liability is recognised, then no disclosure is needed. However, if there is, the following must be disclosed: details of deferred tax assets and liabilities, and the tax consequences of future dividend payments. The major components of the tax expense, so a reconciliation or an analysis of the current tax expense, any adjustments of the taxes of prior periods, any amount of deferred tax expenses. You will come across this with assets, etc. Amounts of deferred tax expense relating to changes in tax rates or the imposition of new taxes. So if in our example the tax rate was 30% up to the current year and it reduces to 25%, the change in the value of a deferred tax asset will be put here. Any amount of the benefit that arises from a previously unrecognised tax loss credit or temporary difference of a prior period. So if, as in our example, the deferred tax asset wasn't recognised until a profitable year, the benefit of these losses brought forward would have to be shown. Any write-downs or reversals of a previous write-down of a deferred tax asset. The amount of the tax expense relating to the charges in the accounting policies and corrections of errors. The standard also requires an explanation of the relationship between the tax expense and the tax that would have been expected to be paid by applying the current tax rate to the accounting profit or loss. This can be shown as a reconciliation. Changes in tax rates need to be disclosed, along with the amounts and other details of deductible temporary differences, unused tax losses, and unused tax credits. For each type of temporary difference and unused tax loss and credit, the amount of deferred tax assets or liabilities recognised in the statements of financial position and the amount of deferred tax income or expense recognised in the profit or loss. IAS 1 also requires the current tax assets, current tax liabilities, deferred tax assets and deferred tax liabilities to be disclosed on the face of the statement of financial position, and that any tax expense is disclosed in the profit or loss section of the statement of profit or loss and other comprehensive income. Now, as you know from your revision, I have only touched on one aspect of IAS 12, and it can come up in your exam in many different ways. You already know the theory of the standard, so you just need to practice questions. So, get to it.